Hello, welcome you all on board FM Financial Management. The name is Rashaad Hussain here with ACCA FM Financial Management. Let's have a look at some common errors. What do you think are the challenging areas of FM? We would have a lot of suggestion. Sure, there are a lot of topics, but the one that needs to be highlighted now is the WACC, the weighted average cost of capital. This session is aimed to simplify the concept of WACC. So this is ACCA's Study Hub, chapter number 11. Let's move into the illustration. And here the illustration goes. Descript Company is a stock exchange listed company that is concerned about raising weighted average cost of capital. No, this is not how you're supposed to read the question. Where do you start? You are supposed to start from the requirement. So navigate all the way. Where is a requirement? A requirement is at the bottom. What is a requirement? Calculate the after tax weighted average cost of Descript Company on market value basis. And then we start off with the first line of the question. Descript Company is a stock exchange listed company that is concerned about its raising weighted average cost of capital. The extract of balance sheet of Descript Company provides the following information. Balance sheet extract. Ordinary shares 25 cents, $4,000. Reserves $1,200. 12 percentage loan notes 1,500. 8 percentage preference shares of $1 each 500. Bank loan 750. Details on these are as follows. The company has got an equity beta of 1.2. Government bonds are trading at 6% and the average risk premium is 7%. The loan notes are currently trading at $106 and are redeemable at par in 5 years' time. The preference shares are trading at 92 cents. The bank loan has an interest rate of 10%. The current share price is $1.25. Tax is at the rate of 30%. Requirement: calculate the after tax weighted average cost of capital of Descript Company on a market value basis. Now, in order to solve this, a very good understanding of all the cost of equity, the cost of debt, the cost of preference shares is required in order to solve this. So, what knowledge is required on this? The knowledge of cost of equity, we have got multiple methods for solving cost of equity. The knowledge on cost of debt, cost of equity could be as per maybe the dividend valuation model where we have constant dividend, or it could be dividend growth model where the dividend grows at a constant rate, or the discounted cash flow techniques. Cost of debt could be irredeemable, redeemable, convertible debt, or the non-traded debt. The cost of preference shares could be the dividend valuation model. Now let's dive in depth to the various tools that we have as far as calculation of cost of equity, debt, and preference share is concerned. Switching to the writing screen. The three major components of cost of capital, or otherwise the WACC. The first one is the cost of equity, the other the cost of debt, and finally the cost of preference shares. In order to calculate the cost of equity, we've got three models. The first model is dividend valuation model, DVM, where KE is equal to D divided by P0, which assumes constant dividend is paid forever and the present value of all these dividends is nothing but the share price. And the next model is the dividend growth model, where KE is equal to D0 into 1 plus G whole divided by P0 plus G. G can happen in the question in three different ways. Either the growth is given, or you'll have to find out the growth as per G is equal to the nth root of D0 divided by Dn minus 1, where D0 is the current dividend, Dn is dividend n years ago, And finally, the third model, which is called the Gordon's growth model, where G is equal to BR. B is the percentage of retention of the profit, and R is the rate of return or the return on the investment. And the third model is the CAPM, which is the capital asset pricing model, which is the only model that considers risk, where K is equal to RF plus beta into RM minus RF. As far as KD is concerned, the cost of debt is concerned, we can mention three major ones. The first one is the irredeemable debt, the one that has to be never redeemed, where KD is equal to I into 1 minus T divided by P0. And then we have got the redeemable, where the cost of debt is equal to IRR of the cash flows. IRR of what cash flows? Year zero, what we would have is the market price, the particulars, the market price. Year 1 to n years is going to be the interest into 1 minus tax, and the nth year we have got redemption value or conversion value, whichever is higher. We will find out IRR of these cash flows, and the IRR of these cash flows is going to be the KD. And the last one is the non-traded debt, such as bank loan, where KD is just equal to I into 1 minus T. And the last one, KP, which is the dividend valuation model, where KP is equal to D divided by P0. Now let's apply this knowledge in that Descript company in order to find the WACC. Getting back to the question. Now, here in the question, let's look at the various costs that we need to calculate. The ordinary shares, we need to calculate the KE. KE is calculated as per three models: the dividend valuation model, the dividend growth model, or the CAPM. What information is given in the question? Let's read the question. The company has got an equity beat of 1.2. Government bonds are trading at 6%. The average market risk premium is 7%. With the information given here in the question, we can identify that K is calculated as per CAPM model. Now the loan notes, the KD, is it irredeemable or is it redeemable? Let's pick it from the question. The loan notes are currently trading at 106 and are redeemable at par in 3 years' time, which means it is going to be redeemable. And KD of redeemable debt is where KD is equal to IRR, the internal rate of return. Now KP is calculated as per the dividend valuation model. And finally, the bank loan, where KD is equal to KD post tax is equal to I into 1 minus T. Let's calculate all these costs one by one. The first one, KE, as per CAPM, what is the formula? It's RF plus beta into RM minus RF. And we have got beta over here, we have got RF here, and RM over here. No, this is not the RM. In several cases, students substitute like this: 6 plus 1.2 into 7 minus 6, which is wrong. Why is it wrong? Average market risk premium is not RM, rather it is RM minus RF. So what is the right one? It's going to be 6 into 1.2 into 7. And that's going to give us 7 into 1.2 plus 6, and that's going to be 14.4 percentage. The KE is 14.4 percentage. Now, the reserves. What are the cost of reserves? Reserves, they belong to the ordinary shareholders, and hence its cost is nothing but KE itself, the cost of equity. The next one is the 12% loan notes, which has specified in the question are redeemable. And here the KD is going to be IRR. IRR of what? Year zero, it's going to be the price that we're going to buy it for, or the market price. And then 1 to n years, it's going to be interest into 1 minus tax, which is interest post tax. And the nth year, it is going to be the redemption value, or or conversion value, whichever is higher. Here this one is not a convertible one, so we are going to rely on the redemption value. The redemption value redeemable at par, the redemption is 100. How much is it trading at? It is trading at 106, and that trading, the price that we're going to buy it for, is going to be considered as negative. It's an investment in it. And how much is the interest? The interest is 12 percentage, making that 12 post tax, and that's going to be 12 into 1 minus 0.30, and 12 into zero point 0.7 is going to be 8.4. These cash flows, what is n? N is going to be 5 years. So both of these n shall be substituted with 5, and the IRR of these cash flows shall be taken as KD. Now the next one is the preference shares, denoted by KP. KP is D divided by P0, and that's 8 divided by how much is it trading at? 0.92, which is wrong. Why is it wrong? 8 percentage is not of $100, it is 8 percentage is of $1, and hence it is 0.08 divided by 0.92, 0.08 divided by 0.92, which will give you roughly 8.7 percentage, which could be rounded off to 8.7 percentage. And finally, the last one that we have is the bank loan, which is non-traded debt. The KD is equal to I into 1 minus T. And how much is it? How much is the interest? As specified here in the question, the bank loan has an interest rate of 10 percentage. 10 into 1 minus 0.30, tax is 30 percentage, which will give me 7 percentage. Now let's have a look at once again. So what do we have? KE, the cost of equity using CAPA model. K is equal to RF plus beta into R minus RF. Substituting the value is going to give me 14.4 percentage KE. And then the next one, which is calculation of KD, the loan notes, which is going to be KD is equal to its redeemable. Hence KD is going to be equal to the IRR. And IRR, what do we have? Year 0, the market price is 106. Year 1, 2, 3, 4. In the 1, 2, 3, 4, what do we have? 4 and 5. We have 12 into 1 minus T, that's going to be 8.4. And the final year, what is the redemption value? The redemption value is 100, and 100 plus 8.4 gives me 108. Finding the IRR of it. The IRR is equal to IRR, open the bracket, select all these cash flows, substitute these cash flows. This is going to give me the IRR as roughly 7 percentage, 6.9 percentage, rounded off to 7 percentage. Third one, KP, which is dividend valuation model, D divided by P0, substituting it as 0.08 divided by 0.92, which is going to give me 0.0869, rounded off to 8.7 percentage. Finally, the calculation of cost of bank loan, which is post-tax KD is equal to I into 1 minus T, which is going to be, what is it, 10 into 1 minus 0.30, giving me KD has 7 percentage. Now, the next thing that we need to find out is value of all of these. Value of these four major sources of fund. What are these? Starting from the equity, how do we find? Whatever is given here is the book value. We need to find out the market value. How do we find out the market value of equity? Market value of equity is going to be 4,000 divided by 0.25 is going to give me the number of ordinary shares, which is then supposed to be multiplied by 1.25 to give me the market value. And when you take market value, you are not going to consider the reserves. The loan note is going to be 1,500. By default, the normal value is taken as 100, and right now it is trading at 106. The preference shares 500. By default, the nominal is 1, and it is now trading at, what is it, 0.92. And the bank loan does not have market value. The same 750 shall be considered as its value. So substituting all these into WACC, for the ordinary shares, 4,000 divided by 0.25 into 1.25 will give me 20,000, and the 12 percentage loan notes, 1,500 1590. How does 1590? 1500 divided by 100 into 106 will give me 1590. This one is 20,000. And the KP is equal to, how much is it? 460. How do we get 460? 500 divided by 1 into 0.92 gives me 460. And the last one, the bank loan is 750 itself. Now, having found all the value, getting the proportion, all these proportion added will give me 1, and taken from the respective working note, the cost, working note 1, 2, 3, 4. The cost was 14.4, 6.94, 8.7, and 7 percentage. How much is the WACC? The WACC is 13.5 percentage. So the after tax weighted average cost of capital of descript company is 13.52 percentage. Now let's have a look at the most common errors as far as the last descript question is concerned. The most common error is that of the risk premium. We've seen several times that whenever the risk premium is given in the question, the students take the risk premium as RM. Risk premium is not RM. Risk premium is RM minus RF. So taking risk premium as RM instead of RM minus RF is the most common error. And next, what we have noticed is as far as the market value is concerned. Now, the book value of the equity was 4,000, and we see that this 4,000 is directly multiplied by 1.25, which is a market value, is wrong. This 4,000 has to be divided by 0.25, which is the nominal value, in order to find out the number of shares, number of ordinary shares, and then multiplied by 1.25. So this is something that has to be taken care. Going wrong in calculation of the number of shares or number of debt. As far as the cost of debt is concerned, in many cases, the candidates don't consider 1 minus t. It is not converted as post tax. So they miss to adjust the tax for the cost of debt in WACC calculation. And then, as far as reserves are concerned, reserves need not be included when you calculate WACC as per market value weights. Why? This 1.25, which is multiplied into the number of ordinary shares, has already got the consideration for reserves. The reserves are only considered when you calculate WACC as per book value weights. And then, as far as value of preference shares, several times we see students taking it as 100, which is not the case. It is mostly $1. It's supposed to be not divided by 100 but divided by 1, and in our last question it is multiplied by zero point 0.2, which is the market value. Huh? So ensure and check what is the market value. The market value is going to should give you an idea about what the normal value of the preference shares are. And then, as far as non-traded debt is concerned, please remember that there is no market value for the non-traded debt, such as what bank loans. So the bank loans shall not have market value. So these are some of the most common errors that are committed by the candidates. Ensure and take care not to do these when you handle the WACC question, the weighted average cost of capital questions. And now you're highly recommended to go to the study hub, and in the study hub we've got this chapter number 11. That's what we were doing now, which is the calculation of WACC. There, yes, you are recommended to do an activity, which is activity number 2, called the lifestyle company. Let's look into that. And here in the study hub, this is chapter number 11, which deals with the weighted average cost of capital, and 11.1.1, the calculation of WACC, where when you come down, we've got this activity number 2, WACC using book value weights. So you are recommended to go through this company called Lifestyle Company. Well, that's all for now. Wishing you all the best for your upcoming exams. This is your tutor, Rashaad Hussain, signing off. Thank you. Bye.